Good morning, ladies and gentlemen. A very warm welcome to you on Business Today Television. This is the penultimate day before the budget, and it's our intense pleasure to welcome Mr. Amit Goel, co-founder and Chief Global Strategist at Pace 360. With Amit, we'll be discussing the broad themes that the budget is likely to present, and of course the way ahead in the market, which for the last 4 months has been in extreme pain. Namaste to you, Amit, and a very warm welcome. We join this event at a time when the Nifty, the small cap Nifty, the Nifty mid cap index, and many other indices are in intense pain. One, how do you see sentiment on the Lal Street at this point of time ahead of the budget?
Firstly, thank you so much for having me on, Shail. And as far as the sentiment is concerned, because I've been watching budgets now for about 35 years, even though we've been in the markets for about 30 years. And my sense is that the sentiment is quite bleak and the market is going very light because there has been relentless selling over the last few months. We've gone down now for the fourth month. Today is actually the fourth month. It's going to end today. And this is the first time in 23, 24 years that has happened. So all this is an indication of how bleak the sentiment is. People have lost a lot of money in the last few months, particularly those of us who were having leverage positions on the futures and options side. So the sentiment is pretty bleak at the moment, but you know that rallies often begin when the sentiment is bleak. So I remain an optimist, and I think the market is very light. Positions are actually very, very light, and FIIs are still sitting on tons of short positions. So in my opinion, the ingredients are in place for a rally. But then, of course, it would be very, very interesting to see how things unfold between today and tomorrow.
Okay. Now, with this background, ladies and gentlemen, let's look at Amit's expectations from the budget. The point here, Amit, is that apart from the fact that markets have more or less, been in a bear grip, we've also had this phenomena of a record low on the rupee, dwindling forex reserves, and of course inflation also being a worrisome factor in the calculus of investing. Now, with this background in mind, what is the fiscal room that you think Finance Minister Nirmala Sitharaman has to either boost capital spending, maybe give some relief to the middle class, and maybe do something for the manufacturing sector, which is facing a downturn both in terms of demand and of course costs. What are your top 3 themes for this budget?
Okay, so firstly, Shail, as far as the fiscal room is concerned, you are absolutely right that the finance minister would probably not like to deviate much from the glide path which they have led us on. So I do believe that this year's fiscal deficit is absolutely in line with what had been projected in July. And I think the next year's fiscal deficit, they would also like to maintain it within the glide path. So in that sense, the fiscal leeway is not huge, but I think the government can, if they can think of some innovative sources of raising money. For example, if they try to go big on PSU divestment, even if they are able to, let's say, strategically divest 2 PSUs, then that could bring them a lot of money. And maybe they can have slightly more ambitious targets for tax collection next year. So I think the market is so fixated on the fiscal deficit percentage that they would not want to disappoint the market even by 0.1%. But by having somewhat looser expectations on the revenue side and probably trying to think of some extra revenue sources, by doing that, they can create some fiscal headroom for themselves. So this is what I believe they would probably try and do. Now, in terms of what the budget could be about, I think there are some low-hanging fruits which the market, which the government and finance minister should definitely adhere to. And for example, I think direct tax rationalization in the form of what has already been talked about, standard deductions, and tinkering with the tax rates to make sure that there is more disposable income in the hands of the salaried classes and the relatively lower income classes. This is one. Then, of course, rationalization of the import duty and GST in such a way that we boost the production of finished goods in this country, and we encourage importing of raw materials and components to make finished products and export those finished products instead of the other way around. So I think they could do some GST and import tariff rationalization. So these are some of the low-hanging fruit. Then, of course, I think a slightly bigger boost on the infrastructure side, a slightly bigger boost on the manufacturing PLI side, including more industries, adding to the pool of subsidies that we have for the PLI scheme. So maybe talking about land and labor reforms, maybe talking about agricultural reforms. So I think if they do some of these things, then the market would be pretty happy that the government is going in the right direction from every aspect. And I think we would get rewarded by a very handsome reaction from the financial markets and from the institutional investors.
Fair point. And both of us know that, a light market coupled with the fact that there is a wall of worry, and enough wall of worry for markets and bull markets to climb back on, is also one of the realities that a large part of the market is ignoring, is also upon us. Amit, let's now discuss what your PMS portfolio is doing at this point of time. What is the level of cash, if at all? And where is the broadest thrust in equity, sectorally or maybe stock wise, that you would want to mention? The last three you mentioned were BPCL, IGL, Manappuram Finance, and there was one more PSU. It slips my mind. Let me just take my notebook out. I'll let you know, but over to you.
Sure. So, Shell, we are now kind of all in, and we continue to buy on the way down.
Okay.
We have bought pretty aggressively in the last about 7 to 10 odd days. So now we are practically at 92% equity exposure in our PMS. So we are going into this budget all in, and this is one. So in terms of how this equity exposure looks like, so of course we have continued to invest in aeronautics, defense, you can say PSUs in general, then of course OMCs, gas marketing companies. We have all these in the portfolio. Manappuram, we were able to reduce our exposure on the way up and book some handsome profits. But BPCL, IGL also, we were able to sort of, because of the bonus news, and today you would note that IGL has gone ex bonus. So IGL, again, we were able to book some profits because the versus IGL ratio was, it had come down to a very low point from where it looked like that it would turn around, and this is precisely what has happened. So we sold IGL and instead we added MGL. So Bhatnagar Gas is also now one of our top holdings, and Reliance Industries is also one of our top holdings. We've got some railway stocks. We've got HAL, and we were able to add on to HAL when the price was as low as 3,400 just about 3-4 days back. ETF. So these are some of the larger.
As a percentage of your AUM, how much would be PSUs?
Yes, that's a good question, Shell. So I think PSUs at the moment, as a percentage of total AUM, is almost as high as 60%.
Okay, that's a very brave bet.
Yeah, but Shell, I think uh, there are a couple of reasons why we did that. So, firstly, we started buying PSUs when they had already come quite a way down from their highs that they made last year. And secondly, within PSUs, of course, we are very well diversified. So we've got pretty much PSUs of all shapes and hues and forms. So we've got banking, we've got your oil marketing, gas marketing, railways, aeronautics, defense, materials, power. So we are fairly well diversified within the PSU space. And what we were also able to do was that some of the other themes that we had latched on to pretty early, we were able to book some reasonably good profits there. For example, some of the NBFC exposures that we had in the form of Bajaj Finance, they gave us handsome profits, Manappuram, and so on and so forth. Private banking, we were able to reduce our stakes at the right time. So there has been some active churning going on. And what we did was that wherever we thought that markets are a little too euphoric or the valuations have become stretched again, we were able to sell some of those stocks and some of those sectors we went light on. And we deployed that money into, let's say, PSU stocks like Reliance Industries, which were doing pretty abysmally till then. So this way, by churning, we were able to
Yes.
on one book profits, on the other hand, buy stocks which were where they which were more beaten down, where the sentiment was downright pessimistic, and the valuations were compelling.
Fair point. And that's the when you look at the valuation part, I was just interviewing, having a conversation with the Bank of India chairman. This is a profit-making enterprise going at a going begging at a PE of less than 6, price to book of less than 1, and of course a fabulous dividend yield and a great profit track record. But what, according to you, Amit, is the market missing? Why are we not seeing, strong earnings growth, valuations which are abysmally poor, getting getting attracted to the market? What is missing?
Shell, if you could repeat the question, because there was some network issue because of which I could not understand the whole question. I'm so sorry about this.
Okay, no issues. I'm just saying that stocks like Bank of India, where the PE is less than 6, price to book less than 1, very strong dividend attractive yield, great future, falling NPAs, yet the market refuses to even acknowledge these kind of earnings. And that's true for across the board in PSUs. What do you think is the missing ingredient?
Right. So I think the missing ingredient, for example, has been that many of the PSUs, compared to some of their private sector counterparts within the same sector, they have lower return on equity. Their earnings trajectory has not been very consistent. They've had a few good years, a few good quarters, but then they've not been sometimes as consistent as some of their private sector counterparts. So I think these are some of the factors because of which many of the PSUs today are at a discount. And plus, let us not forget that many of the PSUs are in industries where where investors think that these are not very, on a long-term basis, not very promising industries. For example, stocks like Coal India, for example, they typically get lower P because the world is weaning itself away from coal. in some ways, of course, it's not happened in the last 2, 3 years that way, but they believe it's going to happen over the next 5 to 10 years. Then similarly, oil marketing, some people think that maybe within 10 to 15 years, you would not need that much of oil marketing companies. You would not need that many of pumps. So these are some of the factors because of which PSUs have attracted lower valuation. But then what we need to see is we need to see the earning visibility over the next few quarters, next few years, and we need to see how the market is positioned. If the market is extremely light on PSUs, then you know that rallies happen. And we've seen periods of time, Shell. You and I have been, talking about markets and investing in markets now for decades. And we've seen periods where PSUs were just not talked about. They were almost written off. And from there, we got PSU rallies. And this is exactly what happened in 2023 and 24. You got those massive PSU rallies, and people were so underinvested in PSUs in 21, 22. So my sense is that while on a multi-year basis, I would not be very bullish on PSUs because many of them have attracted a lot of investment in the last 2 years because of the fact that the prices went up. But within the excessive pessimism that I saw in the last few months made me believe that there is going to be a relief rally. And believe you me, there has already been a relief rally in many of the PSUs. Look at HAL, for example. Look at Bharat Electronics, for example. Compared to their lows of the last few weeks, many of the PSU stocks are already up by more than 10%. So I think it has started unfolding in some ways. And if there is a bit of a favorable budget and we get some tailwinds from the budget and the credit policy on 7th, my sense is that there could be a great relief rally in many of these PSU stocks, which probably would become an attractive sell point for some of us.
Fair point. I understand the fact that fishing at the bottom can be lucrative at times, and of course, you always get a counter rally in a bear market, which seems to be upon us as far as the broader structure of the Nifty and other major indices are concerned. In the same breath, Amit, your view on the IT space. We have a weakening dollar. My apologies. We have a weakening rupee, and of course, a strong America on the cards. It essentially means that IT stocks will do very well because they are export oriented and get their major revenue in the form of dollars. Would you have some exposure in the IT set within PACE 360's PMS?
Not at this point, because see, you would know that IT stocks have actually outperformed in the last few months, and particularly ever since the market tanking down. So we got some amazing discounts and we got some amazing valuations in some of the other sectors. But because there was some defensive buying into IT, pharma, and FMCG, so we deliberately refrained from buying stocks into these sectors. So our exposure to these sectors put together would be very small. I think it would be less than 5% of our total portfolio, maybe as low as 3%. My sense is that IT sector is going to do reasonably well over the next few quarters. I'm not pessimistic there. I'm not bearish there. But it's just that we were trying to look for bargains. And IT sector was not providing us better bargains than they were in, let's say, September. So while some of the other sectors and stocks were available to us at 25, 30, 35, 40% lower valuation. So that's the reason why we don't hold IT and some of these other sectors. But my sectors earning visibility for the next few quarters is pretty good. The pipeline looks good. They get benefit and tailwinds from the rising dollar INR. So the ingredients are in place for them to deliver a great set of earnings for the next few quarters. So probably what we are going to do is, if there is a relief rally post-budget and some of these beaten down sectors that we picked up at very, very low valuations, in case they revert to the mean and we get handsome profits there is a fair chance that we would increase our exposure to IT stocks at that point, but that is not where we are at this point.
Okay. When you refer to the reversion of mean, is it in terms of the price, or is it in terms of valuation? For instance, in the case of HAL or maybe BPCL, what would be the reversion of mean? Where would you want to maybe book 50%, 60% profit, or maybe exit altogether?
Perfect. So reversion to the mean would be both in terms of prices and valuations, because the earnings are already out for the previous quarter. And so basically, so it's all factored into the prices and the valuations. So if the prices go up, the valuations would also go up, and the valuations have come down drastically. So a stock like BPCL, for example, has come down by almost 30% from its top, and so on and so forth for many of the stocks that we hold. So I think there is going to be a reversion to the mean rally. There is going to be a reversion to the mean in terms of valuations. This is one. And secondly, at what point? So we would want to see what budget proposals are like. My sense is that in case of oil marketing companies, one of the biggest factor has been the under recoveries in their LPG business. And I think work is already going on between ministry and these companies to make sure that they get their dues back from the government, because obviously the government would not want them to suffer because of these LPG under recoveries. So at some point in the next few months, they are going to get that money back, and that money is in tens of thousands of crores. So this, once this news comes in, it's going to be a tailwind. Then what is happening is that the oil and gas marketing sector is right now out of the GST purview, as you very well know, that they are still in the old regime of VAT and sales taxes, and not in the GST regime. And my sense is that the government wants to bring them into the GST regime. There may not be great consensus between the center and the states to bring them into GST for all the products. But for some of the products like gas marketing, for aviation turbine fuel, I think there is consensus that they will bring them into GST. And the glide path is pretty clear, that they would eventually come down into GST. There would be very little interference from the government on the prices part. So if that were to happen, I think the oil and gas marketing companies could go up a lot from the current levels. In that case, it's not just going to be a reversion to the mean rally, it's going to be a new bull rally in its own right. So the average P ratio of the portfolio that we have, you would be very happy to note it's less than 15, while the market is still at about 21, 22. So, and you know what has happened to some of these very high P stocks and sectors like EMS, for example. Look at what happened to Dixon. Look at what happened to Trent. Look at what happened to Havells. Look at what happened to Voltas. So the prices have come down significantly, not necessarily because of the earning disappointment, but because the P ratios were unsustainable. So we are at a P ratio of 15 or even less at the portfolio level. So we are sitting very comfortable there. The dividend yield of the portfolio is very high. And some of these stocks in the oil marketing and gas marketing companies, we are not just necessarily looking at a reversion to the mean rally. We are looking at some sort of upgrade of these stocks based on the reforms that the government may introduce in this budget or henceforth. And we are looking at, a big bull rally, let's say, as my best case. And my worst case is that there is going to be at least a reversion to the mean rally over the next few weeks and months.
Fair point. And my final question to you, one stock that you are going long on in the last 2 or 3 days ahead of the budget.
So basically, we don't really play too much for the budget as such. Though of course we have our chosen sectors where we believe that the finance minister is probably going to provide more tailwinds than headwinds. So we would just continue to maintain the same exposure. But I do believe that in terms of aeronautics, defense, automation, railways,
Okay.
manufacturing, infrastructure,
Okay.
housing, I think there are some very, very clear tailwinds which can be expected from this budget. And we probably added a few points of exposure over the last couple of weeks. A, because of the valuations and the fact that there was so much of price destruction. And second, of course, knowing and having this sense that maybe the budget is going to be kinder to some of these sectors. And so far, the market going into the budget seems to be favorably sector, even half as good as what we think it could be. We are looking at a rally not just for the for some of these sectors, but actually for the whole market. And I would want to point out, Shell, that the tweet which Prime Minister Modi sent out on Tuesday, which said that the whole world is looking at this budget and not just India. And this budget is going to be, it's going to fulfill the aspirations of India and Indians, and it's going to provide hope to the whole world. I think, in my opinion, that was very encouraging. And the fact that the RBI also announced its measures around the same time, liquidity boosting measures, I think the government and the RBI are working in concert to make sure that we stop bleeding dollars, that the market stops coming down, that this budget is a pro-business, pro-market, pro-economy budget. And along with RBI's credit policy, both of them will sort of add tailwinds to the budget. This is where we think we are, and we are going into the budget very, very optimistic, Shell.
Right. With these very fond hopes, Amit, let's also look at the daily chart of the Nifty. In the last four sessions, the Nifty has bumped up from a low of 22,786, which was a 7-month low, to somewhere like 23,400. That's a nice 624 point rally over the last 4 days in a market that has been beaten black and blue, ladies and gentlemen. We are at 11:30 a.m. so far, and about 3.5 hours of trade is left. Let's hope that the worst is behind us and that we enter into the budget in a very light fashion after 4 continuous months of relentless selling. And as Amit has very nicely pointed out, this has not happened for the past 22-23 years, that the Nifty has fallen consecutively for more than 4 months. Is a mean reversion in the cards? Will the market react positively to a modest yet hopeful budget? Will the market react very, very aggressively to a very hopeful budget? Only time will tell. But do join us tomorrow at the early part of the hour to listen to the entire budget speech and, of course, analyze markets as they trade live. Thank you so much, Amit. And here's again wishing you all the very best on your very aggressive 60% punt on PSUs as far as the AUM is concerned. And of course, we'll be meeting after the budget.
Thank you so much, Shell. Thank you so much for the opportunity.
Okay. Thank you. That, ladies and gentlemen, was Mr. Amit Goel, co-founder and Chief Global Strategist of Pace 360. I hope you enjoyed the conversation as much as I did, but remain glued on Business Today Television. There's a lot that's happening on the other side of the break.